Every year, businesses lose over $4.7 trillion globally to fraud. In the US alone, companies stated in a recent survey that fraud was expected to result in an overall loss of 2.5% of revenue. That might not seem that big of a number, but the dollar impact is $578 billion per year. And fraud is not just numbers on paper. It destroys or damages reputations, jobs, pensions, and even entire industries. As accountants and auditors, our role is to protect investors and the public by identifying whether a misstatement is an honest error or a deliberate deception. Most mistakes, even those that are very material, are unintentional. They can occur, for instance, because the person pulled the wrong data, ran the wrong SQL query, poured the wrong time, or filtered incorrectly. Many accountants work with large data sets that have hundreds of thousands or even millions of rows of data, and it isn't necessarily possible to spot a mistake visually. In most cases, the accountant should have some way to validate the data and avoid these data gathering mistakes. I always made it a practice to pull a data set that allowed me to tie it out to a financial statement. And the reconciliation of the data to the financial statement became part of the proof that auditors would look at during the interim or year-end audits. Even when the data is correct, the person may arrive at the wrong conclusions and misinterpret the facts. Another possibility is that the accountant did not apply the correct accounting standard. For instance, there may be an industry-specific accounting standard that was not applied. However, regardless of the mistake, the emphasis is on unintentional mistake. When material mistakes were made, it's the auditor's job to detect and report them to the audit committee. Which brings us to the question, what makes a mistake a material mistake? The Supreme Court stated that a mistake is material if there is a substantial likelihood that the fact would have been viewed by the reasonable investor as having significantly altered the total mix of information made available. Auditors established this materiality threshold during the planning phase of the audit and consider the size and nature of the organization, its industry, and regulatory requirements. Each company's threshold is typically a certain percentage of a line item linked to either revenue or net income to determine if a mistake of this number would make a difference in anyone's decision-making process. Accounting fraud is different than an unintentional material mistake and is tied to deliberate and deceptive practices in an organization's financial reporting system, with the intent of presenting false or misleading financial information to stakeholders, including investors, regulators, and the public. The intent of management determines whether the misstatement is a mistaken judgment or a deliberate decision to manipulate earnings. In a court of law, it typically comes down to the credibility of the CFO and CEO who are charged with fraud. Fraud, whether fraudulent financial reporting or misappropriation of assets, involves what is shown here in the fraud triangle as incentive or pressure to commit fraud, a perceived opportunity to do so, and some rationalization of the act. This type of crime is often described as a white-collar crime, but it's not a victimless crime. Accounting fraud not only misleads investors and stakeholders, but it also undermines the integrity of financial markets, damages investor trust, and can have severe legal and financial consequences for both individuals and the organization involved. Detecting and preventing accounting fraud is crucial for maintaining transparency, trust, and the accuracy of financial reporting. This responsibility falls on auditors, regulatory bodies, and the company's internal control systems. Accounting fraud often involves misrepresenting financial data to meet specific financial targets. boost stock prices, secure loans or investments, or hide financial difficulties. It can take various forms, including revenue recognition fraud, involves falsely recognizing revenue before it's earned, such as recording sales that haven't occurred, or inflating the value of sales. This could also include channel stuffing, which involves forcing distributors or customers to take on more inventory than needed, or artificially inflate sales figures before the end of a financial period. Although the customers and distributors will likely return the product, it won't happen until after the financial statements have been issued. Expense manipulation includes understating expenses or delaying expense recognition to overstate profits. Another type of accounting fraud could involve the misclassification of expenses where regular operating expenses are classified as capital expenditures to delay expense recognition. And that was the case with WorldCom, which classified $11 billion in regular expenses as capital expenditures, resulting in the largest bankruptcy case in the US at that time. Asset overvaluation happens when the company inflates the value of the company assets like inventory or property to present a healthier financial position. Liability underreporting happens when the company understates liabilities such as debt or outstanding obligations to appear less risky to investors, whereas off-balance sheet transactions includes keeping certain liabilities off the company's balance sheet to make the financials look better than they are. Enron underreported its liabilities and also had off-balance sheet transactions, resulting in $74 billion in shareholder losses, employees lost pensions, and the collapse of Arthur Andersen. Improper reserves and accruals involves manipulating the amount of reserves and accruals to create false financial stability. And fake transactions involves creating fictitious transactions or companies to fabricate revenues, expenses, or assets. Illegal acts in accounting typically include actions that violate laws, regulations, or other legal requirements. They could take the form of financial fraud, bribery, and embezzlement, as well as violations of specific industry regulations, environmental laws, tax laws, and more. Illegal acts have significant consequences. Aside from financial penalties and legal action, they can result in severe damage to the company's reputation. In these situations, it is the auditor's responsibility to detect and report misstatements resulting from illegal acts that have a direct and material effect on the determination of financial statement amounts. Auditors should also detect other legal violations. However, their primary responsibility is related to the financial statements. Auditors also must determine the proper accounting and financial reporting treatment of a violation and should consult with legal counsel and specialists as needed. The auditors should also report illegal acts to those charged with governance, such as the audit committee, and if the client does not take the remedial action deemed necessary by the auditor, then the auditor should withdraw from the engagement. This action on the part of the auditor makes clear that they will not be associated in any way with illegal activities. Private Securities Litigation Reform Act, PSLRA, of 1995 places additional requirements upon public companies registered with the SEC and their auditors when, one, the illegal act has a material effect on the financial statements, senior management and the board of directors have not taken appropriate remedial action, and 3, the failure to take remedial action is reasonable, expected to warrant departure from a standard, for instance, unmodified audit report, or to warrant resignation. Once the auditor reports to the board that remedial action has not been taken to correct the detected illegal act, the client has 1 business day to inform the SEC under the requirements of Section 10AB of the Securities Exchange Act of 1934. The board should provide the auditor with a copy of the notice provided to the SEC. And if, however, the client fails to report such conduct to the SEC, or the auditor fails to receive a copy of the board's notice to the SEC, then the reporting obligation falls to the auditor, who must then resign from the engagement or provide the SEC with a copy of the audit report the following day. If the auditor resigns, they must still provide the SEC with a copy of the auditor's report within 1 day following the client's failure to do so. As we've seen, fraud is not just about numbers. It's about people's jobs, investments, and faith in the financial system. While mistakes can be corrected, deliberate fraud can bring down entire companies and shake global markets. As future accountants and auditors, you're not just record keepers, you are guardians of trust. Each time you sign off on financial statements or raise a concern, you are playing a role in protecting investors, employees, and the public. So my challenge to you is this: don't just learn the technical rules, develop the courage to ask tough questions and the judgment to know when something doesn't add up. Because at the end of the day, integrity is the most valuable asset in accounting.